What's up? I'm Dan Fredenberg, and this is another chance encounter.
Hey, what's up? I'm Dan Fredenberg. I'm a commercial real estate guy. I'm from the internet. We're seeing more properties like this being built in front of a house. It's going to be torn down soon.
I understand that there are power lines that are getting kind of close.
What's up again? This is Dan Fredenberg, and that there is a commercial real estate building.
I'm joined today with Robert Katz. How you doing today, Robert?
I'm doing very well, Dan. How about yourself?
I'm fantastic, and it is Katz. It's not like Kotz or something, some other.
No, it is Katz, only spelled with a K and a Z, not a C and an S.
All right, I love it. I love it. And I got great news for you today, Robert. I don't know if you're aware of this, but today we are joined by my very favorite member of the audience. And why is my favorite audience member here? Well, obviously, it's because this is a chance encounter where I interview commercial real estate players. That means buyers, sellers, passive investors, deal sponsors, operators, you name it. And you might be thinking, why would you do that? And the answer is if you've ever heard of the private off market deals that you're not allowed to publicly discuss, then you should probably know that the SEC requires a documented per substantive relationship, or else they'll get ants in their pants, and you need to have a 506B exemption if you're going to be involving people who aren't accredited investors, and that frequently happens in this industry, and they tend to prefer that one for private deals. But the important thing to you is you will more effectively communicate in commercial real estate, the deals themselves, the subject of that, and you'll understand how my guest fits into those deals. Before we get too excited about real estate, though, Robert, do you want to give some insight to your background and introduce yourself?
Sure. Again, my name's Rob Katz. For the past 20, 25 years or so, I've been uh, an attorney, litigation attorney, practicing in California, Nevada, Arizona, and Washington. I represented or defended contractors, subcontractors, and developers from claims of construction defect. I also defended, excuse me, product manufacturers from claims of injuries caused by toxic exposure to chemicals, asbestos, and things like that. Most recently, I've been dealing with or practicing what's called lemon law, consumer lemon law, uh, auto product liability. And for the past year or so, I've been investing in multifamily properties.
I love it. I love it. So, the first segment that I always go for here is the five distinct motivations in commercial real estate investors' mindsets. And before I do that, though, I have to say, but wait, check your eight. Now, Robert, I don't know how technologically inclined you are, if you have the ability or not, but maybe you can try looking through the camera and into the user's device down there, because they might have a big, hideous subscribe button that they haven't done anything about yet. And, like the Generation Z, they'll judge you for that. Okay, it's a stupid joke, but I like to give people that little prompt there. It's kind of important so that YouTube starts paying for these videos instead of me. But let's talk about commercial real estate investors specifically. Now, everybody has their own unique reason why they are in commercial real estate and pursuing deals, but I found that they fit pretty neatly into these five different categories. And the reason why it's important to ask about it is because there are plenty of risks involved when it comes to real estate. The fact is, they take months to close, they take years to go full cycle, and therefore get your principal back. And so you need to know what exactly is going to keep somebody from throwing in the towel. And I found that these five categories sum them up pretty accurately. The first one of which is preservation of purchasing power. What on earth is that? Well, some people they earn more than they make each year, so they really ought to be investing a portion of their income every single year, and they need to make sure that that just doesn't dwindle away in the form of inflation. Other people, they're just plain job optional because they've already got a portfolio of assets, and you might ask, well, why would somebody in that situation go through the hassle of yet another acquisition? Well, the answer is if this inflation is eating away from the purchasing power of your cash flow, it's going to be acquisition time. But the other situation is when there's distress in the property or an asset crash, it's really time to become more active and scoop up more properties. Now, of course, everybody should try to get the biggest discount they possibly can on every property they purchase, but the emphasis here is that these people are not going to pull the trigger unless it's really, really in their favor. Now, full disclosure, I'm not there in my commercial real estate journey yet. What describes me much better is trading time directly for wealth. I've got a background in technology. It makes me a high wage, high salary earner, and that means you're going to be paying more in tax than anybody else. Specifically, just so you know my background, it was in the CRM industry. I opened up an agency for that back in 2012, and that eventually led me to online real estate businesses where I ended up making the jump when I saw that my boss was flipping 10 houses a month, making money hand over fist, and it was clear to me that I was in the wrong side of the right business. So that's what I'm after, is those equity multiples rather than just a higher salary and paying more in tax than anybody else. Now, I get that that's a little bit abstract for some people, especially youngsters. Youngsters tend to be of the mindset that they want to hustle like crazy so that they can retire early, but other people, the more common motivation that matches this next one is that they want to control their schedule. They want to work fewer months per year or fewer weeks per month, fewer hours per week, something like that. And that is really why they're in real estate. Now, of course, the only pitfall, the only thing to look out for is many people think that this is secretly everybody's motivation when it comes to real estate, but I assure you that is simply not the case. Some people are fueled by ambition. They're never going to quit because they want to buy their entire hometown. They want that generational wealth, making sure that their great grandchildren never have to hold a day job. And even though that's vilified in some circles, the fact remains somebody has to make sure that they're not asleep at the wheel. They're going to be hustling into their 90s to make sure that these businesses are being run properly, because at the end of the day, that's what real estate still is. It's still a business, and you do need to babysit it a fair bit. And so that's why it's great to have people like that on your GP team. And the last group, they're also motivated to keep on hustling beyond typical retirement age, but that's usually because they found a sector of society, or maybe it's animals, maybe it's the environment, who knows what it is, but there's a financial factor in making a really big impact, and that's why some people are making their commercial real estate acquisitions. So Robert, of those 5 different motivations, what combination of them would you say describes you best?
Um, I think for the most part, I'm looking for freeing up free time and early retirement.
Mhm.
Um, as an offshoot of that, I'd like to help other people achieve those goals as well.
I love it. I love it because absolutely, golden handcuffs. They're a very very real thing. It's really amazing how just about everybody winds up in the same situation, and all roads lead to real estate. Now, of course, that might make me sound overly optimistic, starry eyed and naive, but that's why the next question is the tolerance for risk assessment. If you've ever been involved in one of these 506B deals, these off market private deals that you're not allowed to publicly discuss, then whoever the securities attorney in the mix was, whoever they were, they should have insisted that everybody who's an investor, everyone who's a GP, fills out this super invasive questionnaire, or this financial questionnaire with all these uncomfortable questions like, hey, what's your net worth? What's your investment history? All that kind of stuff. And when I was going through that questionnaire, the one question I thought was particularly problematic, it really lacked utility. It was the tolerance for risk assessment question. I found that none of the options that they typically give really give me something that I can use and to understand where the person's level of understanding is. So I made my own one, and it's a fill in the blanks question. It is: there are many popular investment asset classes, but I think blank is too risky. So, Robert, it can be inside real estate, it can be outside real estate, it can be both. What's too risky for you to invest in?
Um, that is a good question for everybody to think about because there are so many asset classes. Um, and Off the top of my head, I mean, um, everybody talks about these uh, uh, storage units. Um, to me, I think those are a little bit too risky for myself.
Hmm. Hmm. Interesting. Interesting. So, yeah, it's that the one that always attracted me to self storage is the fact that you don't have to be as concerned about evictions. You know, you're not putting a family out in the street, and so like you're just putting stuff at the curb instead. So, I'll be interested offline to get some more to fill in those blanks in that one as
Sure.
well. So that's good stuff. But my next question, this slide here, I actually avoided it for the first couple hundred chance encounters because I thought it was a little bit of a gotcha moment for people who are more front of house, they're more PR, more marketing, that sort of stuff. They're not really the people who are going to be comfortable opening up a spreadsheet and then doing different stress tests in the business model. And so I thought it was not so nice to have that on my guests. But I found later on that, even the people who are more on the financier relations, dealing with investors only, they're still going to focus in on maybe one, two, or three different metrics. And so I decided to start including the slide. Now, it's not an exhaustive list. So if you have one that you like to depend on more, you can go ahead and add it. But for anybody in the audience who's listening and not watching, I'm going to read them out. The first one is cash on cash. Second one is IRR, which is internal rate of return, in other words, the equity multiple. Then there's the cost per door. Then there's the net operating income. Then there's the going in cap rate, which actually is to tell you how much of a discount you're getting on this commercial property compared to other properties that have been sold recently in the area. Then there's the loan interest rate, which is particularly important if you're going to be assuming a loan these days. Then there's the occupancy, which is just the inverse of the vacancy rate. So that just don't get bamboozled by confusing those two terms. Then there's the average income where the property is located. There's the amortization period of the loan, which is particularly important if you're going to be assuming a loan. It's basically finding out, do you have long-term debt? Is it stabilized? That sort of thing. Then there's the difference between the market versus in-place rents. Then we have the population growth where the property is located, which gives an impression that there's going to be some sort of appreciation just due to increase in demand if there's more people. Then there's the sponsor record, which is how many deals are on the go right now, how many deals have gone full cycle. In other words, how experienced are they? Then there's the waterfall split or exit strategy, which is basically talking about what happens to your investment after your capital has been returned. Then we have the DSCR, which is the debt service coverage ratio, which means how much of the loan is accounting for, is how much of a chunk of the rent revenue is going out the door immediately to pay for the loan. So of course that's not an exhaustive list. So Robert, do you want to give like a top three that you tend to look at?
Yeah, one of my metrics that I do look at that's not on that is job growth. For me, one of the first, well, the first two that I like to look at are job growth and population growth. After that, um, it for me it comes down to cash on cash and uh, IRR or ARR,
I love it. I love it.
and then but obviously the DSCR.
Yeah. Okay. Yeah. You pulled a fast one on me, but yeah, the DSCR. You were going to say more about that?
Yeah, the DSCR, the debt service ratio, is a big factor because it I mean it affects everything. if you're paying more for the loan, it's obviously coming out of your net operating income. And if it affects everything. And the fact that the Fed recently lowered rates a little bit definitely helps with achieving that NOI and cash on cash.
I love it. I love it. So the that brings me to the Dan Does Deals Commercial Core Competency Cube, which has the 6 different roles in a commercial real estate deal. That way you can very easily tell if the team seems to be lacking in one regard. The bigger part is to make sure that you learn to more effectively communicate on the subject of a commercial real estate deal, but you'll also understand how my guest fits into those. And as I go through the 6 sides, you might think to yourself, hey, I really need to get me one of those. Well, the good news is it's absolutely free. You go to dandoesdeals.com and there's this big conspicuous button that says download your cube now, and it goes straight to the PDF. Yes, you heard me right. I committed the cardinal sin of marketing, which is you should never, ever, ever give away your freebie without getting some sort of contact information. But it's really important to me that you print this out and you practice this because of those beneficial effects to your ability to communicate. But let's get started. The first side says repositioner. What on earth is that? Well, it's a person who does a bunch of paperwork and looks at a whole whack of properties. Now, what are they doing when they're doing all that paperwork and looking at all the properties? Well, the first thing is they're underwriting the deal, which means they're doing the math. They need to figure out, first of all, is this property actually even making the amount of money that the seller slash broker claims it is? Because okay, so the repositioner has to figure that out, and then they also have to do this math because they have to find upside. They have to use their real estate knowledge to figure out how am I going to get this property to make more money than it is right now. And one of the most peculiar ways dovetails right into what Robert was just saying, which is all repositioners have to have a vast network of financiers. And that is because if you can secure a more advantageous loan, then that's going to go straight to the profitability of the building. In other words, the DSCR is going to go down, so that means less of the rent is going to be going out the door just to pay for the loan. But a financier is not part of the GP team. They only deal with paper, the owners, and money. Okay, so they're not dealing with residents or making those sorts of big decisions. They're really just dealing with finances. So the repositioners have to know lots of them. Sometimes they're called capital raisers, sometimes they're called investor relations, these financiers. But regardless, that's one of the pieces of the puzzle that I think is a little peculiar. But the next place the repositioners obviously going to look is at the operations and say, how do we get these Benjamins to stop going down the toilets? Now, of course, there's more to operations than just unclogging toilets and collecting rents and mowing lawns and all that sort of stuff. Me, in my historically in my GP experience, one of the major pieces that I contribute is the marketing. And of course, I'm focusing on deals where it's 100 units or more. They're on the bigger side, where hopefully you have some third-party property managers in place. But the fact is, if you really think about it, vacancy is the enemy here. If you can't get those units filled, you're going to be losing money. It's going to be killing your deals. So somebody on the GP team needs to have some serious marketing chops so they can get those units filled, even if the third party property manager is struggling. So that's what I'm up to. But there's only so much a repositioner can do to optimize what operations are up to, adding amenities that are cash flowing and that sort of stuff. So the next place that the repositioners generally look is to get a contractor team involved to do a value add. Because if you upgrade the property, chances are the future residents would be more than happy to pay more in rent than the previous ones because it's a nicer place. But if only if things were that simple. You can go ahead and spend as much money as you want gold plating the toilets, but it's not going to give you a return on investment. So it's important to keep your ego in check. And not only that, but see, I don't know if you know this about me, but I'm from the internet. So that means I need locals. I need boots on the ground. I need somebody who can be there in an hour or two, because you bet that will not be me. I'd still be stuck at an airport in an hour or two. So you need to have those boots on the ground who can make sure that those contractors aren't using subpar materials, make sure they're not dragging their heels and not hitting the schedule, also making sure that the operations team, the in-place property managers, they're not just sloughing the photographs and making things seem fine when they're far from fine. And that's one of the things that the locals do. Now, it sounds like I've already given you all the pieces of the puzzle, but to explain the last one, I like to use a hypothetical. Rob, of course, he's an attorney, so maybe you're an attorney, maybe you're a physician, maybe you're an engineer, maybe you own a couple single family rentals, and so you kind of get the idea that when you're buying a rental, you come up with your down payment and then you borrow the rest. So you might get this idea looking at the apartment complex down the street saying, hey, I'd really like to buy that 350 unit apartment complex. I bet if I turned around to my friends and family, we all pitch in like 100K each or something like that, I bet you we could take it over. So full of confidence, you'd head out to the bank and the financiers and say, hey, I want to buy that 350 unit apartment complex. That's tens of millions of dollars. You don't happen to have, say, tens of millions of dollars you want to lend us, do you? Well, you're going to get shot down for one very specific and predictable reason, which is they're going to ask you, who's the sponsor? Who's the KP? What's that all about? So at the end of the day, it doesn't matter which bank or institution you go to, they are lending out depositor funds, and they need to make sure that you're not going to pick up this property, run it into the ground, and lose all of those deposits, all of that capital. So one of the ways that they do that is they make sure that somebody on the GP team, in other words, somebody in the fold, they already own a similar asset. Okay, so if you want to pick up a 350 unit apartment complex, you need to have somebody who already owns a 350 unit apartment complex. On top of that, you need a certain amount of liquidity to show you can actually run the building, and you need to put up collateral, in other words, a balance sheet of at least the amount of the loan. If you have all those pieces, you got yourself a commercial real estate deal. So, Rob, as far as those 6 different roles there, what pieces of the puzzle do you expect to contribute to your next deal?
Um, well, excuse me. You call it a repositioner. I call it acquisitions.
Mhm.
I've been the guy looking for and finding properties to bring to my team for them to analyze and see whether or not it's something we want to invest in. Um, and then, as something that everybody needs to do, if you're getting into multifamily, we all do uh, uh, fundraising,
Mhm. Mhm.
capital fundraising.
Yeah, exactly. The financier piece, absolutely, because we're in the industry of deploying capital, no doubt about it. But the next part is about people. So, I honestly, it's my favorite part about people in this industry. Maybe it's because I came from tech, but we all have our own unique skill sets, and so even though we're always eager to build new teams, make referrals, we tend to hone in on one or two in particular and make that our own. So now, of course, as Rob mentioned, we're all in the industry of deploying capital, so everybody's always eager to find more passive investors. But me personally, because of my marketing and tech background, the sponsors and KPs tend to be who I pursue the most, because they've already got a business where a person like me can make a disproportionately large difference. Now, Rob, as far as you're concerned, if you have any 506B deals, don't go mentioning them and looking for investors at the same time. That's a no-no. But who's in the audience that you're most eager to speak to?
Uh, in the audience that I am most eager to speak to are, as you said, key key partners and sponsors.
Hmm.
Um, those are people that are experienced in the multi-unit family area. They know what they're doing. They've had maybe you know full cycles, meaning they've gone from purchase to sale and everything in between. And those are the people I'm looking to meet with.
All right, perfect. So then let's talk about the buy box, because that's a lot easier, because it's the property themselves. When real estate people are saying, hey, what you looking for? What's your buy box? What's your ideal property? We're really asking for 3 main things. The first one's geography. Where is it? Which state? Which county? Possibly even which neighborhood? It's all definitely going to matter, so make sure you mention that. The second one is size. Primarily on this show, I tend to interview multifamily investors, so that means apartment complexes. And the way that you define size in multifamily is by the number of apartment units. We call it unit count. The reason why it's relevant is because the type of team that will take over 10 or 15 unit apartment complexes, they're going to be fundamentally different from the ones that focus on 100, 150, 350 unit apartment complexes. So that size definitely matters. Now, of course, there's other forms of commercial real estate that don't go off of unit count. They might go off of square footage or acreage, but the same idea applies of why that size is relevant. But the last one is commonly called class. I prefer the term desirability because class is really two things, not just one. It is the condition and the area. If you're talking about the condition, we're talking about how old is the property, how beat up is the property, how recently redeveloped this property is, and then of course what sort of luxuries and amenities are there that make it a nicer place to live. Now when you're talking about area, we're talking about multifamily here, so the school districts are absolutely going to matter, but every type of real estate, the crime rate is going to be very important. And then the last one is the old broker trope. They like to say location, 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 but I think that that doesn't really say much. I think what they really mean is traffic, traffic, traffic. If a gazillion people pass by the property every single day, it's going to be more desirable than a place where it's crickets. But both the area and the condition are rated the same way as in grade school, where you have A plus at the top, and then it's A, and then A minus, and then B plus, and so on. So, Rob, as far as you and your organization goes, where's that sweet spot?
Uh, are you asking location or
I'm asking for
I'm
all
sorry,
three as far as your buy
all the
box.
whole
That
buy
just makes it
box,
easier to say yes to. Yeah.
the whole thing? Gotcha. Well, so let's start with location. I've been looking and focusing on Texas, away from the coasts, secondary markets, meaning away from Dallas and those bigger markets. I'm looking for 1980s vintage apartment units or newer. I'm looking for 6% or better cap rate, 7% ish cash on cash first year. I'm looking for 50 to 200 units. Ideally, I'm looking around the 100 unit mark for myself. I think that's about the sweet spot that I'm looking in. The unit the properties I'm looking at are BC properties um, in a BC area, meaning I'm not looking for the newly built properties in the high end areas. I'm looking for something a little bit more broken in, been
Hmm.
around for a while, and then I'm looking for something that I can value, what's called value add, meaning things that I can add or do to the property to increase the value of the property and increase the rents that I'm asking.
Hmm. I love it. I love it. So now people
Did
must be
I
thinking,
miss
wow,
anything? I think I got everything.
yeah, you got everything. That's why I was cutting you off rudely. But, anyways, it brings me to that next thing, which is everybody in the audience must be thinking, oh, wow, how do I reach out to you to get in touch? Now, of course, I'm going to sandbag that and talk about myself for a second. Now, I'm fortunate to have this super distinctive last name. It makes me really easy to find on LinkedIn, which is where I spend most of my social media time. Now, of course, you'll also notice that I have a hat with a ridiculous real estate is a scam thing on there, which I bought for search engine optimization reasons, obviously. But that's because I also have some books out there available on Amazon on different business related, business building, skill building related subjects. So you can check that out if you want. But if you are going to be raising capital, if you're going to be building a business, you're probably going to need to work with investors. If that's the case, I highly encourage you to pause the video. You can scan this QR code right here with your phone. That'll bring you to the FAQs page of 506 BME, which is the platform that I put together to help people document their substantive relations and also back it up, because the SEC is not going to accept something like, oh, I'm sorry, my laptop fell in the bathtub and now that documentation's destroyed. You can't be publicly soliciting people if you're doing a 506B deal. So that's what that's all about. So, but Rob, if people want to reach out to you, social media, website, email, phone, how should people reach out?
Email, you can reach out. My email is rob@robkatzlaw.com, and that's Katz, not Cats. My number is 702-435-5916, and my website is robkatzlaw.com.
All right, beautiful. And that brings me to the public service announcement. It's not for you, Rob, it's for you in the audience. If you've been watching this episode and experiencing like searing pains in your eyeballs and like migraine like symptoms, I'm really confident it's because of the downright hideous subscribe button down there that you can just hit for free. And full disclosure, I want a gazillion people to click on it so that YouTube pays for these videos instead of me. But the trade-off for you is my videos may show up on your list of suggestions, but you can go ahead and ignore those suggestions if you want. Quite frankly, I just really appreciate the fact that you spent this time with me. Just like Rob, I appreciate you joining me. This is great.
You're welcome. Thank you for having me. It's good to be here.
Awesome. My pleasure. Hey there. Are you interested in commercial real estate deals? Would you like to build your network of investors and deal sponsors? Well, the best thing I can do for you is have you appear on a chance encounter interview as featured on dandoesdeals.com. You may know me from 506B or as a top commercial real estate voice on LinkedIn. And if I had to think of the top factors in your success in commercial real estate, my top two would be your network and your ability to effectively explain how deals work with effective communication. The 15-minute chance encounter format, it checks both of those boxes, and they ensure that you can share your private deals with me without the SEC calling it a public solicitation. So hop onto LinkedIn. You can see my name is over here, Dan Friedenberg, and search for my name. And the best way to reach me and book that is to message me through LinkedIn. And don't worry, it doesn't matter if you decided to enter this space just last week or 2 weeks ago, or if it was decades ago. It'll be fun and easy to look good. We're just asking multiple choice questions based on your core competencies you look to contribute, your level of sophistication, all that kind of stuff. So I hope to hear from you soon. Thanks a lot. Bye.
Does nothing but put more money in the pot.
Right.
If we talk about just the investor side, I mean, Shane talked about the sponsor side a little bit. I'll talk about the investor side. Okay, so you want the most money in terms of return with the least risk. All right, you want to do it yourself, you can go get 13 or 14%. You're going to do all the underwriting, it's not going to be passive.
If you bet, probably not.
I think I'd have to bet at least 2,500 before they fold.
And the pot is
4,000.
4,000. Yeah, I think you're right, but I'd rather just check.
Okay.
First position, you have the right of collection and the right of foreclosure or sheriff's sale, well, you know, wherever you're at.
Make sure you 506B me. Any syndicators, make sure you 506B me.
Hi.
Oh, hey, yeah, here's my code. You got your QR code scanner? Okay, yeah, oh yeah, just hold it right in the square there. Okay, cool. And now you hit open in browser.
Okay.
Okay, are you already logged into 506B me?
Yes.
Yeah, okay, cool. Yeah, so there's my video. So now I'm already on your watch list. So when you get back to your hotel, you can find out what my core competencies are and my level of sophistication. Sound good?
Yeah.
I love your hat. Real estate's a scam. That's really funny.
Yeah.
Nice meeting you.
You too.
506B me, everybody.